do two things. Either you can buy calls, okay,
if your
or you
view
can
is
sell
bullish,
puts.
then
Correct. These are the two options that you have. Okay. Also, in this session, I'm gonna keep everyone unmuted. So if there's any doubt, you can ask on the spot. Okay. Just don't interrupt me. Just let me finish it, and then you can directly ask the question. Okay. Fine. Yeah. So buy calls and sell puts. These are the two options that you have for a bullish view. Correct. Now see, buying calls is very easy. It's nothing, it's very simple. What you do is, for example, if my view is bullish right now, what I can do is I can go and buy 17,500 calls, right? And it hardly requires any capital, okay? It requires very less capital, and it's very easy, okay? And whatever money you have invested in this is the maximum loss that you can take. For example, if I have invested 10,000 in this, that is the maximum loss that I can make, okay? So buying calls is as simple as this, okay? But the difficulty comes in selling the puts. Okay, this is where the difficulty comes in, because to sell one lot of, let's say 17,000 put, let's say your view is bullish in the market right now, and you want to sell 17,000 put option. To sell this one lot, the biggest problem is the capital, correct? And the second risk that you have is unlimited loss. Okay, so this is what we are going to solve in this. Okay, that are these two issues. That is, one is capital, and second is the unlimited loss. Okay. So how we are going to do that is, for example, if I want to sell 17,000 put to implement a bullish view, okay, first problem is the capital, right? So around about, I think you will require around 80 to 90,000 of capital, okay, right now, because since the lot size of Nifty has reduced to 50, it has come down from 1,20,000, 1,10,000 to 80, 90,000 to sell a naked put option, roundabout. Again, it will differ from broker to broker because they have different leverages and margins and all those things. Okay, so again, to sell one lot requires 90,000, which is a big capital, right? In that same 90,000, you can possibly buy 10 lots calls. Okay, so you will think that is much more better. But how you can solve this problem in selling this put is that, for example, I'm selling 17,000 put. Let's say the spot price of Nifty right now is 17,250. Okay, this is the spot price. And I think that market is going to be bullish from here. And I don't think market can close below 17,000. I don't think market can close below 17,000. And it is going to be bullish, sideways to bullish. See, because even if market closes at 17,200, what will be the premium of this on the expiry? It will become zero. Correct? So whatever premium is there right now in this, that is the entire profit that I can take. For example, right now, today is Monday. So let's say 17,000 put is priced at 40 rupees. Okay, so 40 rupees premium I'm getting. But I think by this Thursday, market is going to close above 17,000. So this 40 will become zero if that happens. So that is how you're going to profit in this trade. Simple as that. Okay, but the problem is that, see, 40 into 50 is how much? 40 into 50 is 2,000. Correct? So you'll be making 2,000 rupees on a capital of 90,000 to 1 lakh. Okay, let's take 1 lakh for example. So you're making a 2% return in a week. Okay, which is actually really good. It is not bad, it is really good. Okay, but still, how you can make this more better is that what you can do is, see, this is 17,000 put. Okay, this is already OTM, correct? What you can do is you can go far OTM. What I can do is I can go and buy 16,500 put. Since this is far OTM, this will have a premium of round about 5 rupees. Okay, are you getting this point? What I'm going to do, I'm going to sell 17,000 put option and I'm going to buy 16,500 put option. This is priced at 40, this is priced at 5. Once I do this, what will happen is, to implement this, you will only require a capital of 35,000 approximately. Okay, the approximate capital here, the requirement would be close to 35,000. Okay, now can anyone tell me what is the exact profit you'll make if market closes below 17,000? Or no, not below 17,000, above 17,000. Okay, let's say market closes at 17,150. Can anyone tell me in this position, what will be your profit?
35 rupees.
30, okay, yeah, correct, that is correct, 35. I was expecting in the lot size, but 35 into 5 is, I think, 140, 175. So around about 1750 rupees per lot. Okay, this is the amount you'll be making per lot in how much capital? In a capital of 35,000. Now let me explain why 35. Why will I be making a 35 rupees profit? See, it's simple. Market is closing at 17,150, correct? So this option will become zero on the expiry. This option will also become zero on expiry, correct? Now what has happened is you sold this premium. Since you had sold this premium, you have realized a profit of plus 40, correct? Because 40 became zero and you had sold it. So your profit is entire plus 40. But here you had bought a put option, right? So you had bought at 5. So when you're buying at 5, you will lose if it goes down, okay? So here you have made a loss of minus 5. Because you had bought at 5, it closed at 0. So you have made a loss of minus 5. So plus 40 minus 5 is equal to plus 35. Okay. So that's why you would have seen in some positions, in some screenshots, that people have two positions like this. One is sold of some, let's say 17,500 call is sold. Okay, now let's take put only right now. 17,500 put is sold, and plus 50 is of let's say 16,800 put. Okay, and this is running in a profit of 10,000, and this is running in a loss of let's say 1,000. Okay, so you would have seen this thing in some screenshots. Okay, so this is actually called a spread. What is the meaning of spread? That you are selling one position and you are buying another position to hedge this selling position. See, what is this second position doing is, it is hedging your position. Because if market falls down a lot, it crashes by 1,000 points. What will happen? Yes, in this you will make a big loss, correct. But since you had bought put option, this will come in profit. And further down the market goes, what will happen? Iska loss increase hota rahega, iska profit increase hota rahega. So automatically there will be a certain dead point जहाँ पे you will have a limited loss. उसके ऊपर loss नहीं जाएगा. Why? Because you have bought a put option as well, where you are hedging yourself from a certain blue moon situation. Okay, where something, if market crashes or something like that, something very bad happens, since you have bought a put option, you will be safe against it. You won't make an unlimited loss. I'll give you an example. So we will take the same example. You had sold 17,000 put at 40 rupees and you had bought 16,500 put at 5 rupees, correct? Okay. I gave you an example. If market closes at 17,150, you will make a profit of plus 35. Okay? Now let's say something very bad happens and market goes on to close at 16,000, for example. Okay, something very bad happens, a very big bad news comes out and market goes and closes at 16,000. Now here you will be like, if you only had this selling position, you will be like, Yash, I will make a very big loss. That's correct, you will make a very big loss. Why? Because you had a naked selling position. But if you have done this as well, what will happen is this premium will become 1,000 on the day of expiry because the market has closed at 16,000, and this premium will become 500, correct? Now since you had sold at 40, it closed at 1,000, you have made a loss of minus 960, correct? Here you had bought at 5, it has closed at 500, so here you have made a profit of plus 495. Do you get my point? So your loss is not minus 960, it is less than that. I think it is 564, 65 in my opinion is the loss. If my calculation is not wrong, I think this is the, this is the loss that you make, minus 465. Why? Because you had bought this position. So what is happening because of this? And see, I'll tell you, now this loss is gonna remain same. Let's say market closes at 15,500. What will happen then? This 17,000 premium will close at 1,500, correct? And this 16,500 premium will close at 1,000. Okay. So you had sold at 40, so you made a loss of 1,460. You had bought at 5, so you made a profit of 995, correct? Minus 1,460 plus 995 is again equal to minus 465. So what happens because of this? You have a limited risk. And when does this condition apply? This condition applies anywhere below this strike price that you have bought. Even if market closes at 16,499, you will make a loss of minus 465. Anywhere below this market closes, what is this? This is the hedged strike price. Okay, this is the hedged strike price. Anywhere market closes below this, you will make a loss of minus 465, not more than that. So that is how you have a limited risk in this position. So what was the first two problems that we had discussed? That the first problem is capital, second is unlimited loss. So this thing is eliminated here. How? By hedging your position. And first thing is also eliminated. Why? See, now what will happen is your broker will say that, see, now you don't have unlimited risk. You have a limited risk. Okay, so you are hedged for a very bad situation. Okay, you have a safety. So I will allow you to buy more lots for less capital. So that is why if you take this position, on an average, an approximate money that will be deducted or that will be required is close to 35,000. Rather than 1 lakh, which would be required to take this only. If you only take this and you don't take this, what will happen? You will require 1 lakh capital, plus your risk is also unlimited. Okay, so this is how you create a spread. This is the meaning of a spread. That you sell one position and then to hedge its loss, you buy another position. Okay, so this thing that we have right now discussed here is called a bull put spread. Okay, I'll explain the meaning. See, bull means your view is bullish. And put spread, why? Because you are implementing this bullish view using put options. Okay, bullish, why? Because your view is bullish. You are implementing your bullish view using put options. Correct? So what do you do in bull spread? You can write this very simple thing. You sell expensive premiums. You sell an expensive premium and you buy a cheap premium. Simple as that. Just write these two lines and that is the definition of bull put spread. The easiest, the normal, the basic definition that I can give you for bull put spread is sell expensive premium and buy cheap premium. And when I mean premium, I mean obviously put option premium. Because we are implementing a bullish view using put options. So this is your first strategy, that is bull put spread. See, now one question that can come up is, okay, Yash, we understood. Now let's say, for example, just give me a second, I'll just open the option chain. Yeah. So this is your option chain. Okay. Now let's say right now the market is at 17,069. Okay. Now see, first of all, you know that let's say your view is bullish. Okay. So what I'll do is I will go and sell these put options because right now we are discussing an option selling strategy. Correct. So we are going to sell this put option, and now you need to select a strike price. That which strike price do I sell? Okay. So first thing that I'll tell you, the very basic thing. Okay. Please don't sell in the money options. See, right now market is at 17,069. What I'll do is I'll make a simple rule that I will only look to sell these options. I will not go for these options. Simple as that. Okay, just make a simple rule that I won't sell in the money options. It doesn't make sense. Okay, I will not sell in the money options doesn't make sense. See, because the main agenda of option selling is keeping probability in your side. Okay, just to explain you this thing, what I'm saying right now is, see, try to understand. I told you this thing, option selling has a probability of 66.66%. Okay, let's take the same example. So here I'll just draw this on the new sheet. See, here I am selling 17,000 put, correct? Okay, while the market is at 17,250. Why am I selling 17,000 put? Because my view is bullish. I think market is going to go up till 17,400, for example. That is why I'm selling this. Okay, but let's say I'm proved wrong. Market remains constant and it closes at 17,250. What will happen? I will still make profit. Why? Because this premium will become zero. Let's say I get proved wrong. Market comes down and closes at 17,050. It drops by 200 points. Still I make profit. Why? Because this premium will become zero. So do you see the probability of making profit? You are making profit even when you have been proved wrong. The only time you'll make loss is when market actually falls a lot. It falls by 400 or 500 points. That is when you'll start seeing a loss. Okay, so that's the main agenda of option selling, that is keeping probability in your side. See, already your view is bullish that market is going to go up. It goes up, you will make profit. It remains sideways, you will make profit. If it falls by a little margin, still you will make profit. The only time you make loss is when the market falls a lot. So do you see here how out of 4 situations, in 3 situations you are making profit? So that is the main agenda of doing this option selling. And this option that you can see here is out the money option. Okay, now let's say I'm selling in the money option. Market is at 17,250 and I am going and selling 17,500 put. What will happen in this? If market closes at 17,250 only, I will not make profit because this will remain constant only. This, because 17,500 put will still have the premium because this is in the money option. So I don't have a higher probability of making profit if I'm selling in the money option. So that is the basic reason or basic agenda, that if you're applying option selling, the only reason you would sell in the money option is if you want to make a higher profit, a higher return. But I would always suggest to go for higher probability rather than the return. Even if you make a 4% return a month, you are going to make 48% a year. And this I'm saying even without compounding. So focus on probability more. If you focus on this more, automatically by the end of a year, by the end of a month, you will be profitable. Okay, so don't go for higher returns. Go for safety. Go for low returns but high probability. Even if you can beat Nifty index, you are a good trader. Simple as that. Okay. So this is the reason why I'm saying that don't go and sell in the money option. So what I'll do is I'll make a very simple rule that I will only sell options of either out the money or maximum to maximum. If I'm very, very confident, I will sell at the money. That's it. I won't go above that. I won't go for these options. Because if I start going for these options, my probability starts decreasing. Okay. And the more you go out the money, your probability of making profit starts increasing. Simple as that. Okay. If you want to see that probability can be calculated using delta as well, but again, no need to go into that calculation and everything. For example, if you just sell this, I'll show you. Yeah, here you can see 13%. Just a second. 13% in the money probability. Okay, this is for buy. I'll just do sell. Yeah, 87% out the money probability. So what this is telling you is that if you're selling 700 put option, there is a 87% chance that you'll make profit. Okay, so the more OTM you go, the higher the chance. But also what will happen is your return will also go less, because here you'll only make 10 rupees profit, here only 14 rupees. And the more further up you go, the return goes down. Okay, so that's why these people with very big portfolios and very big capital, like 3-4 crores, what they do is they don't do anything. They just sell very far out the money calls, sell very far out the money puts, and just sit. See, because for them 1%, 2% a week is close to 1 lakh to 2 lakh, so they are happy with that. Okay, see, because what is the chance market can actually go and close above 18,000 within 3-4 days? There's a very less chance. So the probability of making profit in this is close to 99%. Yes, there is a 1% chance that you can make a loss, but again, you know, if market is coming to 18,000, you will see that happening. Okay, and you will have a strategy with you. You will have an exit strategy with you. If you see it is breaking a resistance, it is giving you a breakout, you will not sit and wait and see everything that is happening. You will exit your trade quickly, realize a small loss and move out. Okay, so that is the thing with option selling that you need to understand. Okay, so just coming back to this thing, that is, I'm building a position. So for example, my view is bullish. So I think market will close above 16,800. So I will sell this premium, and what I'll do is I will go and buy a cheaper premium. So I'll go and buy 16,300, for example. Then I can go to analyze. See, how do I select the strike price to sell? That I've told you in OI as well. Go for the strike price which you think is a good support resistance, where there's a good OI. Using those concepts, you can select the strike price. Okay, or you can also select the strike price using support resistance. If you see there's a support at 16,800 put, there is a S3, S4, and you know that it is very difficult for the market to break that, go and short put of that. Okay, so that is the thing there, and then you can buy a cheaper premium. Another question that can come in is that, Yash, how do I decide which premium should I buy? Here you have randomly bought 16,300, right? So how do I decide, should I buy 16,000 put, 16,200 put, or 16,400 put? How do I decide that? Okay, so for that I'll just give you a simple idea. See, there's nothing as such ki you have to keep a 500 point difference or you have to keep a 200 point difference. It is totally on you. Okay, I'll tell you what difference it makes. See, for example, if I'm implementing this particular strategy, the funds needed for this is 41,000. Okay, the higher the spread, right now this spread is of 500 points. The bigger the spread, more the margin. Okay, so if I go and do 16, just a second. Okay, I think my plan has expired. Okay, see, what will happen is the more I increase the spread, this margin requirement will go up. Okay, so that is the thing. So you need to accordingly understand that, what is your funds, what is your appetite, how much capital do you have, and accordingly you need to sell. Okay, just to explain you a few more things here. Here you can see the maximum profit in this trade would be 1650 on a capital of 41,000. Okay, which I guess is a return of 4 to 5%. Okay, 4% I guess. Okay, and the loss that you see here is 23,000. So you'll say that yes, risk reward is very less, right? See, again, this loss that is there, minus 23,000. This loss won't happen suddenly. Okay, what I'm trying to say here is, here you sold 16,800 put option, correct? Why 16,800? Because you think market is going to close above 16,800. Okay, but let's say market closes at 16,750. Then you will think that you will make this loss, correct? No, that's wrong. You won't make this loss. Okay, I'll show you how much loss you'll make. Okay, I think this is also gone. See, I'll tell you the exact loss that you'll make in 16,750 is 16,800 put, right? That will become 50 if market closes at 16,750. Okay, and this will become 0, correct? 4 becomes 0, 37 becomes 50. So here you have realized a loss of minus 13, and here you have realized a loss of minus 4. Total minus 17. Minus 17 into 50 is how much? I think close to 1650 or 1700 rupees. That is the loss you make. When will you make this 23,000 ka loss? This will only happen if market goes and closes below this level, 16,300, the premium that you have bought, the hedged position strike price that I told you initially. Agar market iske niche jaake close hota hai, that is when you will make 23,000 ka loss. And this strike price that you have bought is 800 points away. Okay? So there's no need to be scared or something like that. You will make 23,000 ka loss as soon as market goes below 16,800. That won't happen. Your loss will start like 1,000, 1,500, 2,000 like that. And it will keep on increasing in front of you. So if you want to exit at a certain point of time, you think that no, this is not working, you can exit. Okay. So that is the thing here. Okay. So this is your bull put spread. Okay. Any doubts in this, you can ask right now.
Sir, that 1,35,000, I got confused about this.
I'll show you. See, for example, if I decide to sell only this 16,800 put and I remove this hedge position, just give me a second. See, if I only decide to do this and I don't take a hedge position, look at the funds needed, 91,000. Okay, now if I hedge it, just give me a second. If I hedge it with the certain cheaper premium, what will happen? Your fund comes down, requirement 41,000. Why does it come down? Because you are hedging yourself from a very big loss. Okay.
Okay, sir. Nice.
Okay. Okay, this is a good question. Which one to buy first? See, what I'll suggest you is if you are implementing this certain strategy, what you can do is first buy this position, buy the hedged position, and then sell. Okay. So if I'm implementing this certain position, what you have to do is first buy this, okay, and then sell this. Okay. First buy the hedge position and then sell the put whatever you have decided to sell. Okay. Now another question that will come in is that Yash, I trade in Zerodha, and Zerodha sometimes does not allow you to buy very OTM strike prices. Like for example, they set a limit. They set a strike price ka limit कि you can only buy strike price from 16,500 to 17,500, something like that. They set that thing as well, right? So for that, what you can do is then you'll have to sell first and then buy first. But since you're selling first, understand that you will require a 91,000 capital. Once you sell first, this 91,000 will get blocked, and then once you buy this, out of this 90,000, 50,000 will get freed, and only 40,000 will be cut. Okay? But if you're buying this first, what will happen? Once you buy this, only I think 4 into 50 is how much? 200 rupees. So 200 will be cut from your funds, and once you sell this, then 41,000 rupees will be cut. So for example, if I only have 50,000 with me, then you have to buy first and then sell, because you don't have 91,000 to sell first and then buy. That's why. Okay. So that thing you need to do. Another thing is that what to do with that limit, OI limit, strike price limit, is this is the only thing you'll have to sell first. Then you'll have to have a higher capital. Okay. Otherwise, change the broker, go for angel broking, go for Kotak Securities. There they don't have much OI limits, much strike price limits. Okay.
But you see, Sensible itself allows you to do the thing, to have a basket order or something like that.
Exactly. You can here just click on trade all, and that will directly link with your.
That's what I have to do.
Yeah, true.
Yash, what is the basic reason why people are selling in the money put? I mean, I know a couple of my friends selling in the money puts.
See, it doesn't make sense. I'll tell you. I'll give you an example.